The American dream used to follow a simple formula. Work hard, save 20%, buy a house, and let time do the rest. But in 2026, that formula no longer works. Mortgage rates are hovering around 7%. Institutional investors are quietly buying entire neighborhoods like it's a high-stakes game of poker. And for the first time in modern history, the ladder to homeownership hasn't just been pulled up. It's been chopped into pieces. So now, a new question is emerging. What happens when people can no longer afford to own anything? Today, we're exploring the rise of something called fractional living. Is it the last remaining path into the market? Or are we slowly becoming micro-shareholders in a world we used to fully own? Let's take a closer look. The 2026 reality check. To understand where we're going, we have to look at where we are. In the 1970s, the average home cost about 3 times the average annual salary. Today, in many major cities, it's closer to 8 times. This isn't just a housing bubble. It's something more structural. A supply chokehold. There simply aren't enough homes for the number of people trying to buy them. But supply isn't the only issue. The real competition is no longer your neighbor. It's institutions, hedge funds, private equity firms, algorithm-driven buyers. They're not purchasing homes to live in. They're purchasing them for yield, for cash flow, for long-term control. And when you're competing against an entity that doesn't sleep, doesn't need a mortgage, and doesn't raise a family, you've already lost the bidding war before it even begins. The pyramid scheme argument. So this raises a difficult question. What exactly is a 30-year mortgage? Because if you zoom out, it starts to look familiar. You take on a massive amount of debt. You spend decades paying it off, often paying double the home's original value in interest, all while assuming that someone else will eventually pay more than you did. But what happens when the next buyer can't afford it? The system depends on continuous growth, higher prices, higher demand. But we're operating on a finite planet with finite incomes. At some point, the chain breaks. And that's exactly why alternative ownership models are no longer just trends. They're becoming survival strategies. What is fractional living? This is where fractional living enters the picture, or more specifically, fractional ownership. The idea is simple. If you can't afford to buy the entire asset, you buy a fraction of it through apps, platforms, and blockchain-based system. You can now invest as little as $100 into a rental property in Austin or a vacation home in Bali. In return, you receive a proportional share of the rent and a share of the appreciation. On the surface, it sounds like the democratization of real estate, access without barriers, ownership without the full burden. For the first time, you're sitting at the same table as institutional money. But there's a catch. The dark side of the micro-howner. When you own 0.01% of a home, you don't actually own a home. You own exposure. There's no front door, no keys, no place to live, no control. You can't renovate it. You can't move into it. You can't even decide what happens to it. In reality, you've become a passive financial participant in someone else's property. You're not the owner, you're the liquidity. And this is where the real risk appears, the gamification of survival. Because if housing becomes just another tradable asset, like stocks or crypto, then something fundamental changes. We stop fighting for the right to live in homes and start trading them like digital tokens. And in that world, who really wins? The platforms, the ones collecting management fees on every transaction, every property, every fraction. The exit strategy. So, what do you actually do? Because waiting for a housing crash might not be a strategy at all. Institutions are sitting on massive reserves of capital, often called dry powder, ready to buy every dip. So instead of waiting, you adapt. First, stop renting your life. If homeownership isn't immediately possible, that doesn't mean your money should sit idle. Second, think in terms of asset allocation. Fractional platforms can provide exposure, but they are not a substitute for shelter. Don't confuse investing with living. And third, redefine the goal. The new version of the American dream isn't tied to a single address. It's tied to portable equity, assets that move with you, global index funds, decentralized systems, and yes, even fractionalized assets. Use strategically until you reach a position where full ownership becomes possible again. In conclusion, the American dream isn't gone, but it has changed form. It's no longer about a house with a white picket fence. It's about something deeper: financial sovereignty. In a world that increasingly benefits from you staying a tenant. So the real question is, where do you stand? Are you a buyer, a renter, or a fractional participant in the system? Let me know in the comments. And if you want to understand how large institutions are quietly reshaping the housing market in 2026, check out the next video. I'm JV, and this is Money Explained.